Good morning and welcome to the live series Straight Off the Bat. Join us on Thursdays as we speak to individuals across multiple industries who will help you understand financial literacy and education. If you join us from Facebook, thank you so much. Don't forget to like and follow our page to continue seeing content that will help you manage your money. I'm your host today, Pauline, and we're discussing home ownership and mortgages. Our guest today is Kieran Ramdeen. He is the Home Finance Manager at Scotiabank Trinidad Tobago Limited. He holds a master's in finance and has 14 years of banking experience. In 2016, he was a top sales officer in Trinidad and Tobago and Eastern Caribbean region. So we're going to bring him in because 60 minutes is a long time for a lot of people, but when it comes to mortgages, this is a lifetime of education we're trying to squeeze into 60 minutes. So Kieran, how are you?
I'm okay, Pauline. Good morning, Pauline, and good morning to all our viewers.
Amazing. So you are quite a popular person because we posted this event and we've had quite a number of people very interested, including me, because as I told you earlier, I also have been looking at mortgages more along the lines of I've had some really questionable rental experiences being a renter. So I want to really look at homeownership. So this timing of this live show is perfect. So I want to step back a bit before we get into any technical jargon or fancy words. What exactly is a mortgage, Kiran?
All right, so Pauline, excellent question. So to kickstart things, a mortgage is basically an instrument that the bank uses as real estate. So land or house and land that we utilize as security to advance funds to individuals. So I know later on in the show we will speak to the different types of mortgages, but basically it is real estate, right? In which we use as security to advance the funds to our customers. Oh, Pauline, sorry, I'm not hearing on my end.
Sorry, that's a schoolgirl era. I was on mute. I had, secrets to so many things just now I shared, but it's gone now. So when it comes to home ownership, because we talk about, buying a piece of land back in Barbados, because that's where I grew up. I want you to explain to us, what are the fundamental steps involved in purchasing a home and securing a mortgage? Because the idea of, owning a home seems great in the grand scheme of things, but the process in itself can be a little bit daunting. So could you break that down for us, Kiran?
Yes, definitely, Pauline. So, fundamental steps in securing a mortgage. The first thing, and I'll repeat the first thing that you need to do as a potential homeowner is to get pre-qualified. That is critical, right? Reach out to us as a mortgage specialist to get pre-qualified. The pre-qualification process basically will give you a good gauge, one, in not only in how much you qualify for, but also some of the terms and conditions associated with obtaining this dream home. Right. So during the pre-qualification process, we will speak to things such as the rates, fees, terms and conditions, as well as the down payment. And when I speak to fees, it's important for someone to understand how much do I need to inject in this transaction to be able to purchase this new home, right? So we will discuss stuff like the bank processing fees, legal fees, down payment. So that will give you a good gauge in terms of how much I could budget, how much I need to budget for to purchase this new home, right? So that's the first step, getting pre-qualified. The second step is once you're pre-qualified is looking at that dream home, start house hunting, right? You want to go out there, you want to find something within your budget, right? We've seen we've seen a lot of times where real estate agents reach out to us and customers not pre-qualified. So they're looking at a property and they may not even be able to qualify for it. So that's the second step, getting finding that dream home. Once it is that you find that home, right, you want to make sure and reach back out to us, right? Because we want to also understand the details and information pertaining to that house. And we'll go into more details as it relates to some of the things we look for when it is that we're looking at what property can we finance and utilize as security to advance that mortgage, right? So Once it is you identify, you reach back out to us, and we have that further discussion to make sure that it falls within the bank's risk appetite, right? The next step will be doing a valuation. And again, later on, I'm sure we will discuss the importance of doing a valuation, but a valuation is critical in the process of purchasing your new home, because the important thing is we want to understand what is the value and other key elements within that valuation that we need to look at to determine how much you could qualify for. Once it is that you complete the valuation, then you proceed to sign the sale agreement. And this is where it becomes a little ticklish, because we've seen a lot of customers come into us and they have already signed that sale agreement before even getting pre-qualified and even up to not doing a valuation, right? So it's important, and that's where we as financial advisors will hold your hand through the process. So signing a sale agreement, once you execute the sale agreement, we start the searches. And searches is basically us engaging an attorney, right? And we have a panel of attorneys who will look at the property, look at do a full search on the property, ensuring that there are no title issues, right? The owner, the person who is selling the property, is in fact the legal owner, right? And there's no issues with the property. And they will also advise in additional documents that will be required to finalize the transaction, right? From there, we will obtain any legal documents as well as any documents that will be required to meet the final conditions of our mortgage. And then once we reach that stage, is a matter of disbursing the mortgage, right? So
Okay, Kieran.
these are the basic steps required when it is that we look at applying for a mortgage.
Well, thank you so much for that. That's definitely information that we all need. You can hear me?
Yes,
You
here
can
in
hear me,
Ukraine.
right? Okay,
Yes.
great. Shout out to Crystal John. Good morning to you as well. She's joining us in this session. So, Kieran, I want to step back a bit and have this discussion around the pre approval and credit, right? Because we've been doing this live show for a number of years and we get a lot of feedback and we have some insight onto how people, value cash versus credit. And when we talk about credit, the idea of borrowing money, people don't, even me, I didn't grow up with someone sitting down with me and explaining what a credit score means or, you know, um, when you have a credit card, because some people think credit is free money. So there's just a lot of miscommunication with this. So, how does a person begin with building their credit? Let's start with that because pre approved requires credit, no?
Correct. So the first step, and this is critical, again, obviously coming into a mortgage is a big transaction, right? And the bank, that's the first thing as a financial advisor we look at is how well has this person paid their debts, past or current debts, right? And because we speak in credit history in total. So what I will advise our viewers is very critical and important that we understand, first of all, credit history and how it impacts us applying for future credit, right? So it's twofold. So basically, the first thing is, okay, I have credit history, but am I paying well? So that's the first thing, right? You want to understand the importance of credit history. Credit history can ultimately determine whether or not a customer qualifies for a facility or not, right? Because as I mentioned, that's the first thing we look at. Whilst you may have a good income, you have minimal debts, good savings, etc., you can possibly not be eligible for a mortgage or any other facility because of slow payments on your credit on your credit history, right? So it's important that one understands the importance of credit rating. And one of the things that I want to bring to the table is basically we've seen where customers are comfortable paying monthly installments, like the loans, the fixed installments. But where they have the challenge is the revolving facilities, such as credit cards. So it's important as when you apply for, especially the revolving facilities as credit cards, that you sit with your financial advisor and fully understand how the payments work, because a customer with a credit card especially could be paying every month, but they're not paying on time, right? Which obviously will impact your credit score, right? So it's important to understand your due dates on your credit card and exactly how the payments work, right? Because we've seen that multiple times. So that's if it is that you have credits and credit history. If it is that you do not have a credit history, then applying for a $2 million mortgage, how does the bank now look at this? Because at the end of the day, we have not seen your ability to really pay any debts and understand if this person is mature enough, if they have the experience with the credit history. So it's important that individuals look at the option of even taking a small loan or a small credit card just to establish that credit history, which obviously will help when it is that you apply to the bank for the larger facilities such as your mortgage. So it is critical, and this is one of the easiest way someone can be turned down for any other facility with slow payments on their facility. So it's very critical that persons understand how credit scores work and the importance of repayment.
Thanks for that, Kieran. I mean, in summary, it sounds like you're basically building a relationship, right? So there needs
Yeah.
to be history of some kind for the bank and you to like, okay, this is a something that we could get involved in because it's a huge relationship that may take a lifetime. So shout out to Ren Joseph. Good morning to you as well. We do have a question from Stacey Anna. Should you go to the bank or credit union to finance the mortgage?
Right. So I can speak to the bank, right? We at Scotia, I can speak to what Scotia has to offer, and we have very competitive packages when it comes to mortgages, right? From the rates, we also have cashback available based on customers' profile, right? Which assists in your legal fees and sometimes can actually cover all the fees associated with the transaction. Average of a $1.2 million property, we do 3% of the mortgage amount, max 40,000. So in that case, will be $36,000, right? As a first-time homeowner, $36,000 should cover your legal fees and any bank processing fees, right? So separate and apart from your down payment. So we have a really good package at Scotiabank, right? One thing to note, a lot of persons come to us and ask the question, okay, I'm 50 years old. Can I still apply for a mortgage? Can I get a 30-year mortgage? Right? And the answer is yes. Right? Scotiabank does not discriminate against age. Right? Whilst it is, we understand that, okay, you're 50 years, the mortgage will mature at the age of 80. What you want to understand is that if it is that we don't lend to this individual, the possibility exists that this person might just rent for the rest of their life. So it's a very, very good option that Scotia has, right? That we can still afford a customer a mortgage. Some of the benefits, and this is where we come in as financial advisors to let a customer know that basically, whilst it is that you're taking a mortgage for, say, 30 years and maturing at the age of 80, we have options available such as lump sum payments, etc., to still work towards paying off the mortgage in a shorter possible time, right? So those are some of the things that Scotia brings to the table. And one other thing that a lot of persons are not aware of is that we do in fact have a bi-weekly payment option, which saves you not only on your total interest cost, but also reduces the term of the mortgage. So we have a lot of benefits coming to Scotia. On the credit union end, it's important to understand what the package is. That's critical, right? So comparing, you'll want to understand what the credit union is offering opposed to the bank, and then make that informed decision. So we as financial advisors will hold your hand through the process and guide you in terms of what is possible on our end, and then you make that informed decision from there.
All right, so we have some activity in the comment section. So Ren, we're going to we responded to your question because that's more of a credit card conversation. Today we're going to focus on mortgages, but surely you can sign up for communication with future BATT events, and we can look at actually adding that to another live event. So we're going to cover a few things. We have some questions from Priya as well, and we want to find out what a sales agreement is. But we'll do so right after the break. We'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. If you're doing so from LinkedIn, don't forget to subscribe to our page to continue seeing content that will help you manage your money. I'm your host, Pauline, and today we're discussing home ownership and mortgages with Kieran at Scotiabank Trinidad and Tobago. So we're going to bring him in because the comment section is active and we have a lot to cover and not in that much time. So I'm going to get to your questions a bit, guys, but before I do, I want to ask you, what is a sales agreement? Because a sale agreement in the context of the mortgage conversation that we're having right now, just in case anybody may have missed what we had discussed earlier. So, Kieran, what is a sale agreement?
Right. So, Pauline, a sale agreement basically is a legally binding agreement between a vendor, and vendor meaning person selling, and a purchaser. Right. Is basically offer and acceptance. So you have a property to sell. I'm an interested purchaser, right? We engage, we understand the terms and conditions of the sale agreement. So the sale agreement basically covers and has specific terms within the agreement. So one of the important things, well, the most important thing within the sale agreement is how much am I purchasing for? Right? The sale agreement also covers stuff like the address of the property, if there are any covenants or any other things that one needs to pay attention to. One of the major things that you want to look at within your sale agreement is the length of time you have. Right? In Trinidad and Tobago, the standard time is 90 days. Again, that can be changed depending on the negotiation between vendor and purchaser, right? But a sale agreement is where when you sign a sale agreement, it means that a vendor has agreed to certain terms and conditions to sell this property, and a purchaser has agreed as well. So at the point of signing that sale agreement, I, as a purchaser, will be handing over a down payment check, and that is your offer and acceptance, right? Some sale agreements, sale agreements can be tweaked. Some vendors accept the 5% because we know in the market at Scotiabank, we can do up to 95% financing, right? Some persons still may ask for the 10%, right? So it could be tweaked accordingly based on the customer's pre-qualification, right? With pre-qualification will kind of guide the vendor in terms of taking that 5% or less than that 10%. That is normally the standard within a sale agreement.
Okay, so thank you so much for that again, Kieran. We're going to head over to the comment section because I don't want it to run away from us, and there are a lot of questions. So we're going to start with Priya. How do you determine as a first-time homeowner the amount needed for legal closing fees and stamp duty?
Right. So very good question, Priya. Thanks for that. So within our pre-qualification process, right? What we do as mortgage specialists is that we not only assess how much you qualify for, but we go the extra step in confirming how much is the legal fees. So at the point of getting pre-qualified, when you leave that interview on that day, you will know exactly or have an average of what are the fees associated with the transaction. So what we do, we actually engage one of our panel attorneys to get a quote, right, to determine what is the estimated legal fees in this transaction. So as I mentioned earlier, legal fees together with all other fees associated with the transaction, once you come in to get pre-qualified, you will be leaving knowing how much you need to inject in this transaction together with your down payment to cover all fees.
All right, thanks for that question, Priya. We're gonna go into another question coming from Ren on Facebook. What's the process if you want to move your mortgage portfolio from one institution to the bank?
All right, nice. So the process is pretty simple. So similarly, you will get pre-qualified, right? You what we will do is in this case we would not have a sale agreement because you already own the property. Once it is that you're pre-qualified, the next steps will be conducting a valuation and a search, right? The valuation basically will determine what percentage financing we can lend to now not only switch the mortgage across to Scotia, but also a lot of persons look at the option of switching not only because of preferred rates or packages, but also consolidating debts. And it's a really good question because I want persons to understand that a lot of persons have equity on their property and they really don't know the options available. So what we can look at doing is understanding, okay, for example, if the balance on your mortgage is say 600,000 and the property is worth 2 million, then there's a lot of equity on the property. So not only a straight switch to settle the existing mortgage, but we can also look at the option of consolidating other debts that the customer may have, right? They may have other needs such as home renovations, educational expenses for their children, purchasing another property, purchasing land, for example, right? That we can look at the option of giving them that additional equity within that within switching the mortgage, right? So that they could purchase the other property or incur those other expenses.
Okay, so we have a few more questions, but we're gonna get back to those. We have some from LinkedIn as well in a bit. I want to go back to the conversation around a sale agreement. So, when should a sale agreement be signed and down payment made?
All right, so sale agreements. So a lot of persons, Pauline, just to share, as I mentioned earlier, a lot of persons sign sale agreements before a valuation. And I want to speak on that because it's critical for persons to understand when do you sign that sale agreement, right? As I mentioned to you, a sale agreement is a legally binding agreement that you have and engage this vendor person who is selling for a certain price that you're purchasing for and a certain timeline in which to complete the transaction by. And just want to take a little step back to let you understand, first of all, how important a valuation is. And I will give you a quick example. If it is that you're pre-qualified for 90% financing and you're purchasing a property, for example, for $1 million, then what that basically means is that you have to inject in the transaction $100,000 and the bank finance is 900,000, right? This is where the valuation comes in and it's so critical. We lend based on the lower of the two, which is the purchase price and the value. So in this example, if the value of the property is $1 million plus, then you're fine, we could lend the 90%. But if the value comes in at, say, for example, 900,000, then the lower of the two in this instance is 900,000. So we can only lend 90% of that 900,000. So you've now moved from injecting $100,000 in a transaction to $190,000 in a transaction. So I just tie in both in because I want persons to understand how important that valuation is. And it's just as critical as getting pre-qualified, right? So remember, going back to the sale agreement, you signed that agreement agreeing to purchase the property at $1 million. You have committed to purchasing that property for $1 million. There's no negotiation from there. You've already committed to that purchase price. So the importance, again, I'm showing you the importance of doing the valuation before. You want to ensure that one, the property has the value, and separate and apart from that, you want to ensure that the property meets the bank requirements. So not only the value, but the bank also looks at some of the other key areas that the bank looks at is the remaining economic life of the property. And what that basically means is when the evaluator visits the property and does the assessment, they will be able to determine with general upkeep and maintenance of this property, how long will this property last, right? Because obviously a property will have a certain lifespan. And our mortgage term is dependent on that. And basically, our policy is that the remaining economic life of this property, if it is that it must be 5 years more than the term of the mortgage. So what that basically means is that if it is that I have to do a 30-year mortgage, then the remaining economic life must be 35 plus years. The other thing that's critical within the valuation is if there's any work required on the property, because we want to ensure from a bank perspective, as well as the customer, that the property that we're purchasing is in an average or better condition. If it is not in an average or better condition, then we may need to understand what work is required to bring the property into average or better condition. And persons may have, most likely will have to inject that additional cash in the purchase to bring that property into average or better condition. So to tie it back into the sale agreement, when do you sign the sale agreement? I will advise persons sign it after you complete your valuation because it's critical. I've just explained how important the valuation is and some of the key things that we look for as lenders within that valuation that can potentially impact you. Because once you sign that sale agreement, just for persons to understand, if it is that you cannot complete that transaction within that 90 days, the vendor has the option to do two things. They can either extend to give you a little more time to secure the financing to complete the transaction, or your down payment could be up in the air and the vendor can as well seize the down payment. Or I've seen within recent times, vendors, but if it is that they have to give you additional time, they apply a penalty for that additional time. So it's very important for persons to understand how a valuation impacts the ability to complete the application. So to the question, when do I sign the sale agreement? I sign the sale agreement after I complete my valuation, and I'm comfortable that not only it has the value, but it also meets the bank requirements. One way to mitigate that though, Pauline, is what I recommend to customers, because we've seen where persons, they get in a good deal, they're comfortable, they know, they think that they will get the value, etc., and they want to sign that sale agreement before doing that valuation. What I recommend to customers is negotiate with the vendor, because the sale agreement can be negotiated to include a clause within that sale agreement that basically states this agreement is subject to a valuation being completed by the bank with a value no less than, in the example I gave, $1 million, meeting the bank requirements. This allows a purchaser to then negotiate, because if the value comes in lower, right, then they can go back to the vendor to say, listen, it didn't come in at $1 million, so we can now negotiate, right? Similarly, by doing the valuation up front, it gives you that negotiation power to say, listen, it came in at $900,000. I'm willing to meet you halfway at $950,000, or I'm only willing to purchase at $900,000, right? But you have not committed at that point in time.
Okay, so definitely feeling the passion through the screen, Kieran, and so is the comment section, because people want to know which branch you're at and how to contact you. We may need to get you back just
Sure.
a few more times. So we have a question from Staceyana, which I'm going to get to in a bit. And I think I'm very biased because I also want to know the answer to this, which is, what is the typical age of a person should be making a mortgage so they can retire comfortably? Because generational wealth is such an important factor that, the terminology is going around, and I'm like, is it too late for me? But we're going to answer that question right after the break. We'll be right back. welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from YouTube, don't forget to subscribe to our page to continue seeing content that will help you manage your money. I'm your host, Pauline Joseph, and today we're discussing home ownership and mortgages with Kieran from Scotiabank Trinidad Tobago Limited. So we have a wealth of knowledge that has been shared over the last 30 minutes, and we have so many questions to answer for the next 30 minutes. So let's get back to Staceyana's question, which is what is the typical age a person should be taking a mortgage so they can retire comfortably? Stacey, thanks so much for asking this question because I want to know as well. Kiran, let us know. Give us the financial advice.
Nice. Very, very good question. So, Stacey, a person's life stage is important. That's critical, right? And as a financial advisor, this is where we hold our customers' hands through the process. And when we look at the customer's life stage, we look at anywhere between 25 to say 42 persons typically will engage us to purchase their new home, right? But going back to the life stage, what we've seen is typically persons now starting off their first job at the age of 18 to probably 22, 23. They will come in for these small loans, these small credit cards, then they will work their way up, probably a roll on, roll off vehicle or a brand new vehicle, and then look at the option of home financing. And that's why I'm very happy to be part of this wonderful initiative for persons to understand that to try not to start too late, right? It's all about planning, it's all about preparation, right? And basically, the typical term of a mortgage is 30 years. So, and retirement is 65, right? So, typically, we will want persons to apply and obtain their first mortgage by the age of 35 so they can comfortably retire and settle the mortgage at that point in time, right? What are some of the things that one can do to ensure that they're able to settle the mortgage before the age of retirement is utilizing the option of lump sum payments to your mortgage, right? And looking at the option of doing so, what the benefit of making lump sum payments is basically you're going to benefit from not only reducing the term of the mortgage and paying it off faster, but also you're going to save on total interest cost, right? So it's important for persons to understand the options available, right, to be able to pay off the mortgage. So average age 27 to 42, give or take, right? And that's why we want to encourage persons to start earlier. As best as possible, we know things happen, and obviously, it's all about planning, right? Ensuring that you have the savings and you put things in place to be able to be in that position to qualify and apply for that mortgage.
All right, and appreciate all that advice. Knowing that it's not too late for me, but for anybody who may be watching this who they are over 42, what advice would you give to them?
First advice is reach out to us, let us assess your financial position, and get you pre-qualified. We want to understand. So we've encountered where persons, Pauline, have quite a number of debts and they need to settle the debts, or they don't know what options are available. And this is where we will hold their hands and guide them through the process, right? So persons maybe 50, 53 on the line, don't be afraid. We are here to give you that additional support, right, and give you that encouragement to still look at you purchasing that dream home, right? We will assess you, we will sit with you, have that discussion, and look at the options. And when it is that we are assessing our customers, we look at everything. We take everything into consideration from your debt service ratio, meaning percentage of income going into debts, right? How much savings you have, etc. And some of the things we want to look at is, for example, setting up structured savings plans to see if you could pay off the debts, one, as well as have the down payment and have the fees associated with the transaction to make sure that you could still afford that dream home.
Well, it sounds like hope is out there, and as you said at the beginning, it's really having that conversation relationship with your bank. We
Correct.
have we have quite a number of questions in the comment section, and I think it's going to steer the conversation because I'm seeing a question coming about a small business, right? One from Jane Defoe in Facebook, and I love the question around small business because I actually am or wasn't still in that position where I thought they don't actually support small businesses, and I was proven wrong, thankfully. But Jane wants to know, can a small business apply residential mortgage, and what is the criteria to apply?
Yes, so definitely, we the option is available. Whilst you may be self-employed, what we do is we assess the self-employed income. So we have various ways to do so, right? For example, a self-employed person may be getting a fixed salary. So that's one thing that we look at. Or we may need to get additional documents pertaining to the business as a whole, right? So the option is definitely available, even if that you're self-employed, for us to assess you and purchase that residential home for you, right? So the option is available. We treat it similar to what we do for gainfully employed persons. So don't feel that is any different. The documents will be different, but the application process and the discussion is along the same lines. So
Okay.
reach out to us, and definitely we will be able to assess you from there.
We definitely have to get your contact. And guys, I see in the comment section asking to reach out to Kieran, and we will ask you to sign up for our mailing list, and we will send you his information. So I want to still have that conversation around small business owners because we have KP Dolly on YouTube asking, starts off a bit negatively, but I understand banks do not favor small business owners when it comes to applying for loans or credit cards. I used to think like that as well, but I realized it's building a rapport and showing your deposits because when I got my first business loan, it was just, it felt really good to be like, okay, I'm worthy of this. So is my business. So for the question for you, Kiran, is how can a small business owner qualify for a mortgage?
Right. So again, assessing the individual, right? So some of the key things that a small business owner will want to understand is we need to be able to determine what is your income, right? So there are various ways, and Pauline, you hit the nail on the head there. Is basically one, you want to make sure that you have an established, right, and you pass all your funds through the account, so we can have a true reflection of what type of income this business is generating, right? From there, we will then be able to determine and have an idea as to what is the income for us to now assess you to purchase that new home, right? So once it is that we can verify your income, there are different methods of verifying the income, such as the deposits. Some persons bring financials, right? So there are different methods to verifying and validating the small business person's income. And once we identify that, definitely, again, once we can identify the income and we could confirm the actual income of this individual, the process from there is the same as a regular individual who is gainfully employed, right? So once we have the documents, we definitely can look at the option of getting you pre-qualified.
Okay, I wish someone had told me that a few years ago because it was very overwhelming. I was like, why is this not happening? And I was like, oh, okay, so this makes sense now.
Right.
And it's such a interesting process because if you are not sat down and told these things, you feel frustrated because a lack of information brings this frustration behind it. But it is possible, guys. I am proof of it. I want to shift the conversation to, well, we've been neglecting LinkedIn. So we're going to head over to LinkedIn for a minute and answer Ariel Francis' conversation, which I have no idea what DSR is. So I'm hoping that you can expand on
Okay.
that. But Ariel asks, what's your DSR percentage rate? So let us know what DSR is, just for those
Okay.
who don't know what it is and what it is.
Nice. So good question. So your debt's total debt service ratio, TDSR, is total debt service ratio, and that is basically percentage of income going into debts at any point in time, right? So the range, it ranges between 35% all the way up to 65% based on one's profile, a customer's profile. And what that basically is that the bank, when it is that we assess a customer, we take into consideration their income, whether it is self-employed, whether it is gainfully employed, right? And what we do is basically, based on the customer's profile, we will determine what percentage this customer qualifies for, right? So basically, what we do is we take into consideration the current monthly installments that the customer has, as well as what the new facility, the installment for the new facility will be. And this is a way to mitigate and ensure, right, that the customer doesn't overextend themselves when applying for a facility. So to give a quick example, if a customer is earning, for example, $10,000, right, and we complete the application, your debt service ratio might be 40%. And what that basically means is that, including the debt that you're applying for now, your total monthly commitment should not exceed $4,000. And the reason for that is this: when it is the bank provides financing to you, whether it's a mortgage, unsecured loan, etc., we want to be comfortable that you can pay this facility whilst still maintaining a lifestyle that you're accustomed to, whilst you're able to still save on the side, right? And that you're not overextending yourself. Because again, $4,000 going into that in this example, you have a residual of $6,000. We want to ensure that you could still save on the side. You're catering for unexpected and unforeseen expenses, emergency expenses, etc. Remember, you have your utility bills, etc., that you will have to take into consideration. So we want to ensure that you don't overcommit yourself whilst applying for this facility.
All right. Thank you so much for that question, Ariel. I'm going to stay in LinkedIn and head over to, I just saw it. Okay. So this is a great question. I'm not seeing your name, unfortunately, in LinkedIn, but it says, how does one already having existing loans, such as car loans, affect their ability to obtain a mortgage?
Nice. So going back to that service ratio, again, examples help, right? It simplifies how we do stuff, right? So basically, uh, all debts we take into consideration, and again, once we complete the application, we can then determine what is your debt service ratio limits, right? Again, it varies dependent on customers and customers profile, right? We will factor in the current loan, and again, given an example, customer probably spousal joint income, say 30, say $20,000, and your limit is 40% or say 50%. What that basically means is that, including the mortgage that you're applying for today, your total debts can't exceed $10,000. So what we will do now is I will sit with this individual to say, here's what, this is your current debts. Currently, you're paying $4,000 a month. So the most that you can pay on this new facility, this mortgage that you're applying for, is $6,000 to bring you to that $10,000 per month, right? For example, that $6,000 might be a mortgage for 1.2 million. But you may say, here's what, Kieran, I want to get a property for 1.5 and the installment is 7,500. How do I get to that stage to now qualify? What I will now do is I will look at that customer's current debts. So they may have a credit card, they may have an unsecured loan, and probably the vehicle loan. And I will now say, okay, Mr. Customer, these are the options available. Currently, with your current debts, you can qualify for 1.2. However, if it is that you pay off the vehicle loan or you pay off the two loans, you can now qualify for the 1.5. And I will give the customers the options from there to then determine how much do I want to extend myself to, and what options are available to now settle these debts to now qualify for that $1.5 million. So tying in that question to your debt service ratio, and I basically explained there how can I now still qualify. But if it is that you're unable to pay off the auto loan, then the discussion will be what options are available. Probably we set up a structured savings plan, right? So that within 1 year or a year and a half, you will be in a financially better position to now qualify for that facility. Because when we meet with a customer, the important thing is, for me, is that even if you don't qualify I take the time to explain to you what options are available to put you in that position that 1 year, 2 years, 3 years down the line, you will be in that position to qualify and purchase that new home. So I hope that answers the question.
Yeah, and definitely looking at the comments, and folks are um, definitely taking it in. Great advice, Kiran from Shivani. All right, so we have. I'm really apologize, guys. We're gonna try to get to as many of your questions as possible. Unfortunately, we won't be able to get to all, but that means we will have to ask Kiran to come back. Let's hope he says yes. All right, so we want to really find out about first-time home buyers, and what do we need to think about? What is the list that we need to create? So we're gonna answer that question as well as a few more in the comment section right after this break. We'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from Facebook, don't forget to subscribe to our page, continue seeing content that will help you manage your money. Today, we're discussing home ownership and mortgages with Kieran Ramdeen from Scotiabank Trinidad Tobago. And we have so many questions to answer, and we only have a short time to do so. So we're going to go quickly into this question that has to do with, when you're a first-time home buyer regarding saving for down payment, and what type of other upfront costs associated with purchasing a home that we should know about. So first-time home buyers, you're talking to them now, Kieran. What would you tell them?
Right. So as a first-time homeowner, again, during the pre-qualification process, we want to understand terms and conditions of your mortgage, right? So the first thing is we will want to explain to the customers what is your upfront cost and how much do you need to inject in this transaction, right? So a few fees that customers need to be aware of is a valuation fee. So we did speak on valuations before, right? A valuation is a fee that is absorbed by the customer, right? To ensure that one, we have the value and it meets the bank requirements, right? We have the bank processing fee. So there is a fee when you apply for a mortgage that will be applicable. The other and big fee will be your legal fees, and legal fees are broken up in smaller parts, right? One, searches, right? The attorneys will have to do a search on the property, ensuring that the title, the person selling owns the property, and that there are no title issues. And they will also give us advice in terms of if there's anything additional as it relates to the legal side of things, right? Stamp duty is a major cost that persons need to be aware of, right? As a first-time homeowner, there is in fact an exemption as first-time homeowners for stamp duty exemptions, which helps significantly. And with our cashback that is available, um, subject to terms and conditions, this can easily cover majority of the fees up to 1.2 million, right? So if it is that you're doing a mortgage up just around 1.2 million, our cashback usually covers majority of the fees. Separate and apart from the fees will be a down payment, right? So as a first-time homeowner, again, going back to the point, getting pre-qualified, at that point in time, we will be able to give you a proper figure to work with, right? So we can work together to ensure that you have sufficient savings available to purchase that new home.
All right, thank you for that answer. So I'm doing my best, guys, to comb through the comments. For those who aren't asking specifically questions to mortgages, unfortunately, we can't answer those questions right now, but we will bear in mind for future live shows, as well as sign up for future live shows. So I'm heading back to Facebook, and we're going to look at a question that has to do with land from Emma Tate. Um, What is the mortgage process for buying land and building your own home rather than purchasing a house? Great question, Emma.
Right. Excellent question. So we've seen an increase in persons looking at the option. Again, persons wants to build something that is what they like, right? They don't want to just buy a ready-made or a property that is already built, and they want to build something to their specs, right? So the first step in is to acquire the land, right? So you want to get pre-qualified again, we go through the process and you acquire the land. The next step after acquiring the land is to determine what exactly do you want to build. And determining what you want to build, you want to take into consideration as well what is the cost in doing so, right? So it's important that whilst you want to build that dream home, you want to ensure that it fits within your budget. So whilst doing your plan, so the first step when you acquire the property is do your plans. You need to engage an architect, right, who will complete your plans. You will want to also engage your builder to have an idea as to what is the cost associated with building that house, right? Once it falls within your budget, the next step will be they submit the plans to town and country and regional approval to get the necessary approvals to build that structure on that said piece of land. Once it is you get the necessary approval from both town and country and regional corporation, then you visit us again to now start the pre-qualification process. So basically what will happen is that we will review the plans, right? We will need to engage a quantity surveyor. So a quantity surveyor is basically a professional that the bank relies on to review the plans. And because of them being a professional in this field, they will give us an accurate figure, right? As best as possible, how much will it cost to build this house, right? Because we've seen instances where a contractor give an estimate just to win the bid, right? And they halfway in the construction, they turn around and say, hey, this is not sufficient money to complete the work, right? So we rely heavily on the quantity surveyor, who is the independent professional body or person to advise us, okay, based on this property that you're interested in building, it will cost $1.2 million, right? So once it is we engage the quantity surveyor, the next step will be engaging our valuators to determine what is the projected value of this property once it is completed, right? So step by step will be purchase the land, get your necessary approval from town and country and regional, right? You will get your contractor's estimate. We engage a quantity surveyor to advise what is the cost. If there's any difference or significant difference in cost between the quantity surveyor and your contractor, we will want to understand what is accounting for that. And the reason being is a lot of persons, again, a room could cost 100,000 and the same room could cost $10,000 in building because of what it is, the material that you use. Probably you use a more expensive material. The tiles, probably porcelain tiles, costing $80, opposed to the contractor using ceramic tiles, right? So those are the kind of things we want to take into consideration to understand what is the difference, and we want to make sure and be aligned to make sure that the quantity surveyor and the contractor are both aligned in terms of what is the actual estimate to complete this work, right? So we completed the quantity surveyor's report, we completed the valuation. The next step from there is to get your actual approval to now disburse the facility. So taking you back a little is that it's important at the point of purchasing the land that we do an assessment to understand how much more money do I need to inject in this transaction to complete the construction as well. Because separate and apart from your down payment that you would have paid in the initial stage of purchasing the land, you want to understand what is the additional cost, because there are additional costs involved in terms of building. So one of the main things that we need to ensure is you need to have a contingency in place, and it varies between 5% and 7%, depending on if it's a fixed or variable contract. And the reason for that contingency is for cost overruns, right? We know and we've heard multiple times customers purchase building their home and they didn't budget for certain things, or cost escalation for material, etc. Prices went up, and obviously we want to ensure that the property is in a position to be completed. So we do in fact have additional costs, right, to make sure that the customer has that funds available in the event that they need to utilize it to complete the construction, right? So once we complete the projected valuation, the next step will be to get the approval for us to then disburse that mortgage for you to build that home, right? A few things and important things to note during the home builder process is that one, we did a projected valuation. At the end of the construction, we will need to get a final valuation to confirm that the property is now 100% completed. So you have to take into consideration there will be two valuations being completed. With respect to the quantity surveyor will give an initial figure in terms of how much it will cost to build. And during the building process, the bank will advance funds on a phased basis, right? So, for example, if it is that you're taking $1.5 million to build that home, we may say, based on the contractor, they may say, okay, we can do it in three phases, so $500,000 each. At each stage, the quantity surveyor will visit to ensure that the construction is on track to be completed, and that the first 500,000 injected in the transaction, that it would have been utilized. The important thing to do though is to understand is when it is the quantity surveyor visits, there will be a cost. So every time they visit, they will have to do a report to the bank to make sure that whatever amount was advanced was actually in fact utilized. And the important thing to note is this, that you don't want to utilize the full 500,000 and then advise us, okay, Kieran, I need to get an extra drawdown. We want to kind of manage it because we want continuity in the construction stage. So what you will do is probably when you reach 425,000, you engage us to let us know that, hey, Kieran, we've reached this stage. We want to get a quantity surveyor to come and visit, right? We could account for the difference of the $75,000, right? So we can now advance the other $500,000 to make sure that there's continuity, because the intention here is to ensure that the customer could potentially complete the structure in the fastest possible time, right? So we will want to ensure that we don't have any delays in terms of keeping back this customer to complete this construction of the property. Yeah.
All right.
So
And on that note, we definitely agree with Sintra Ramsaran. She said it's very informative, very good job. And unfortunately, we can't get to any more of the questions because we're out of time. But we have pinned to the top of the comment section how you can access Kiran, because clearly there's way more information for all of us to access, and hopefully we can look back at reviewing this. So thank you so much for sharing your insights today. Thank you to Kieran Ramdeen from Scotiabank Trinidad Tobago for joining us today and sharing insight into home ownership and mortgages. Don't forget, you can check in these comments to sign up to be notified on our next live show. And always be sure to like and follow our pages across social media so you don't miss a single live show. Thanks again for joining us, and we'll see you soon. Bye.
bye.